Hello everyone, welcome back to the channel. Today, we're delving into a fundamental topic for those looking to build a secure financial future: bonds. I know what you're thinking. Bonds? Aren't they super boring and for old people? Well, I'm telling you, it's not true. Bonds can be an incredibly powerful tool, especially if you're just starting out in the world of investing. We've all seen the headlines about stock market fluctuations. It can be stressful and intimidating, especially if you're new to investing. That's where bonds come in. They offer a more stable and predictable way to grow your wealth without spending sleepless nights worrying about market crashes. In this video, we'll demystify bonds, explain exactly what they are, why they're a great option for beginners, and how you can easily start investing in them today. So grab your favorite beverage, sit back, and let's begin your journey to financial freedom. Okay, now what is a bond? In its simplest form, a bond is basically a loan. When you buy a bond, you lend money to an entity, which can be a corporation, a government, or even a municipality. In return, they promise to return a fixed amount of interest over a specific period and then return your original investment, known as the principal, at the bond's maturity. Think of it this way. Imagine your friend needs to borrow $100. You lend them the money, and they promise to return $5 in interest each year for the next 5 years, and then return the original $100 at the end of that term. That's basically how a bond works. You are the lender, and the bond issuer is the borrower. Now, it's important to understand the key terms associated with bonds. On one hand, there's the principal, which is the amount initially invested. Then there's the coupon rate, which is the annual interest rate. And finally, there's the maturity date, which is the date the bond issuer repays the principal. Understanding the fundamental concept of a bond, that it's a loan with predictable returns, is the crucial first step on your journey. Once you grasp this basic premise, the rest of the world of bonds becomes much easier to understand. Furthermore, the price of a bond can fluctuate in the market before its maturity date. If interest rates rise, the value of your bond could decrease slightly, and vice versa. However, if you hold the bond to maturity, you are guaranteed to recover your principal regardless of these market fluctuations. Okay, now you have a clear idea of what bonds are. But you might still be wondering, why are they so suitable for beginner investors? Well, there are several compelling reasons. First and foremost, bonds offer a level of stability that you can't get with stocks. The stock market can be a roller coaster, with prices fluctuating wildly depending on the news, economic conditions, and investor sentiment. Bonds, on the other hand, tend to be much more stable. Their prices are less volatile, which means you're less likely to suffer significant losses in a short period of time. Imagine you're building a house. Stocks are like those fancy decorative elements. They can add a lot of value, but they're also more susceptible to damage. Bonds are like a foundation. They're not as flashy, but they provide a solid base that supports everything else. Another key advantage of bonds is that they provide a predictable income stream. Unlike stocks, which may or may not pay dividends, bonds pay a fixed amount of interest at regular intervals, usually semi-annually. This can be a great way to supplement your income, save for a specific goal, or simply generate a passive income stream that helps you achieve financial independence. Additionally, bonds can play a vital role in diversifying your investment portfolio. Diversification is critical to smart investing. By spreading your money across different asset classes, such as stocks, bonds, and real estate, you can reduce your overall risk. Bonds act as a counterbalance to the volatility of stocks, helping to stabilize your returns over time. Think of your portfolio as a balanced meal. Stocks are the protein, providing growth potential, while bonds are the carbohydrates and healthy fats, offering stability and consistency. You need both to thrive. Finally, bonds are relatively easy to understand. Compared to other investment products, such as derivatives or options, the concept of a bond is fairly straightforward. You lend money, receive interest, and recover the principal. It's a simple and transparent investment that anyone can understand, even if you're completely new to finance. While it's true that all investments carry some level of risk, bonds are generally considered a safer and more conservative option than stocks, especially for those just starting out. They offer an excellent way to get started in investing without exposing yourself to excessive risk. It's important to understand that there are several types of bonds you can invest in, each with its own characteristics and risk-reward profile. Let's explore some of the most common and accessible options. First, we have U.S. Treasury bonds. These are issued by the United States government and backed by its full faith and credit, meaning they are considered one of the safest investments in the world. When you buy a Treasury bond, you are essentially lending money directly to the U.S. government, which uses those funds to fund its operations and various programs. Treasury bonds come in various forms, including Treasury bills with maturities of less than 1 year, Treasury notes with maturities between 2 and 10 years, and Treasury bonds with the longest maturities, usually 20 or 30 years. Next, we have municipal bonds, often called munis. These are issued by state and local governments to finance public projects, such as the construction of schools, hospitals, roads, and other infrastructure. Municipal bonds often offer attractive tax benefits, making them an attractive investment for many people. Finally, there are corporate bonds. These are issued by companies to raise capital for various purposes, such as expanding their operations, investing in new technologies, or acquiring other companies. Corporate bonds typically offer higher interest rates than Treasury bonds because they carry greater risk. When investing in corporate bonds, it is critical to carefully evaluate the creditworthiness of the issuing company. Credit rating agencies, such as Moody's and Standard & Poor's, assign ratings to corporate bonds based on their assessment of the issuer's ability to repay its debt. Bonds with higher credit ratings are considered lower risk, while bonds with lower credit ratings are considered higher risk. Each type of bond has its own advantages and disadvantages, so it's important to carefully consider your investment objectives, risk tolerance, and tax situation before deciding which type of bond is right for you. Diversifying among different types of bonds can also help reduce your overall risk. Okay, now you have a good understanding of the different types of bonds available, but the big question is, how do you invest in them? The good news is it's easier than you think. There are several practical ways to add bonds to your investment portfolio. One option is to buy individual bonds directly. As I mentioned before, you can buy U.S. Treasury bonds directly from the government through the website treasurydirect.gov. This is a great way to buy and hold Treasury bonds to maturity, ensuring you receive full interest payments and a return of principal. By buying bonds directly, you essentially cut out the middleman, saving on commissions. However, it's important to note that you need a brokerage account to buy corporate and municipal bonds directly. Another popular option is to invest in bond funds. These funds are mutual funds or exchange-traded funds, known as ETFs, that invest in a diversified portfolio of bonds. This is a convenient way to gain exposure to a wide range of bonds without having to research and purchase individual bonds. Bond funds come in various categories. There are funds that focus specifically on Treasury bonds, corporate bonds, or municipal bonds. There are also funds that focus on bonds with different maturities, such as short, intermediate, and long-term. Choosing the right bond fund depends on your investment objectives and risk tolerance. Before investing in any bond or bond fund, it is essential to do your research and understand the risks. Read the fund's prospectus carefully and consider speaking with a qualified financial advisor if you have any questions or need personalized advice. A financial advisor can help you assess your risk tolerance, investment objectives, and time horizon to determine the most appropriate bond investments for your specific situation. Remember, investing in bonds is a long-term strategy. Be patient, stay disciplined, and focus on building a diversified portfolio that aligns with your financial goals.
Now, before you rush out and buy every bond you can find, it's crucial to understand that, like all investments, bonds aren't completely risk-free. While they're generally considered safer than stocks, there are certain risks you should be aware of.
One of the most important risks is interest rate risk. This refers to the possibility that the value of your bonds could decrease if interest rates rise. When interest rates rise, newly issued bonds become more attractive because they offer higher yields. This can cause the value of older bonds with lower yields to fall. Another important risk to consider is inflation risk. Inflation is the rate at which the prices of goods and services increase. If inflation increases faster than the interest rate on your bonds, their real return will be lower or even negative.
Credit risk is another factor to consider, especially when investing in corporate bonds. Credit risk is the risk that the bond issuer will default on its debt and be unable to pay the principal or interest. Bonds issued by companies with lower credit ratings have a higher risk of default.
Finally, there is liquidity risk. This risk refers to the possibility that you will not be able to sell your bonds quickly and easily if you need to access your funds. Some bonds trade less frequently than others, which can make them difficult to sell, especially during periods of market stress. It is important to be fully aware of these potential risks before investing in bonds. By understanding these risks and taking appropriate precautions, you can minimize your potential losses and make informed investment decisions. Okay, now you're well informed about the potential risks and benefits of investing in bonds. To help you navigate the bond market with confidence, here are some essential tips to keep in mind as a beginner. First and foremost, start small. Don't feel pressured to invest a large sum of money right away. Start with a small investment you're comfortable with and gradually increase your bond exposure as you gain experience and knowledge. Second, diversify your bond investments. Don't put all your eggs in one basket by investing in just one type of bond. Instead, diversify your portfolio by investing in a mix of Treasury bonds, corporate bonds, and municipal bonds. This will help reduce your overall risk and improve the stability of your portfolio. Third, consider your investment time horizon. If you're investing for the long term, you might be able to tolerate more risk and invest in bonds with longer maturities. If you're investing for the short term, it's generally best to opt for bonds with shorter maturities to minimize the impact of interest rate fluctuations. Fourth, do your research. Before investing in any bond or bond fund, make sure you fully understand the risks. Read the fund's prospectus carefully and consult a qualified financial advisor if you have any questions or concerns. Fifth, don't chase yield. While it may be tempting to invest in high-yield bonds, also known as junk bonds, these bonds carry a significantly higher risk of default. Be extremely cautious when considering high-yield bonds and make sure you understand the risks before investing. Finally, rebalance your portfolio periodically. As your investments grow and your financial goals evolve, it's important to rebalance your portfolio periodically to maintain your desired asset allocation. This may involve selling some of your bonds and purchasing more stocks, or vice versa. Consult with a financial advisor to determine the best rebalancing strategy for your individual needs. Investing in bonds can be a smart and effective way to build wealth and achieve your financial goals. Just remember to stay informed, diversify your investments, and be disciplined in your approach. With the right strategy, bonds can be a valuable asset in your investment portfolio. So there you have it, bonds demystified and ready for your investing adventure. They're no longer just for your grandparents, they're a crucial tool for building a diversified and stable portfolio. Remember, investing is a marathon, not a sprint. Take your time, do your research, and most importantly, get started. Even small bond investments can generate significant gains over time.
If you found this video helpful and informative, please give it a thumbs up and subscribe to the channel for more valuable investment tips and strategies. And don't forget to turn on the notification bell so you don't miss any new videos.
Thanks for watching, and happy investing! I'm confident that with the right knowledge and strategy, you can achieve your financial goals and build a better future for yourself and your loved ones.